What does risk actually mean? You hear this term all the time in finance. Balance risk and reward. We all get the reward part. More money. But when someone says beware of risk, what are they actually telling you to do? Hey, I'm Alex. I had to figure out money the hard way by starting and running my own business. Just to be clear, this isn't financial advice. I started this channel to explore what I'm learning as an investor and small business owner. Please do your own research and take everything with a grain of salt. So what is risk? Well, I like Charlie Munger's idea of solving a problem by first inverting it. So let's start by discussing what risk isn't. For a long time, people said risk was just volatility, when a stock goes up and down over a short period of time. But is that really risk? To me, volatility isn't necessarily bad. If a stock drops sharply and I still believe in the company, that's a buying opportunity. Volatility might feel risky, but it's not the same thing as risk. The first person who made this clear to me was Howard Marks. He wrote a memo years ago that completely changed how I think about risk. Marks' core idea is quite simple. Risk is everything that could go wrong that you didn't know to account for. After you've considered market conditions, the company's balance sheet, and competitive threats, risk is still what's left over. It has nothing to do with volatility. It's the unknown unknowns. That's risk. The investment writer Morgan Housel talks about this too. After the 2008 crisis, everyone became hyper cautious about the housing market. But the next crisis probably won't come from housing. We're too prepared for that. The real risk will come from something we're not watching. But history does repeat itself, because human nature doesn't change. I'm reading The Great Game, and it's a history about Wall Street. And it's wild how often investors fall for the same traps. That's why understanding history matters. It helps you see patterns others miss. So risk isn't volatility. It's something much simpler than that. Losing money. And now, every investor occasionally loses money. You might call it part of playing the game. So real risk is losing money that you can't recover from. Your winning investments out-earn your losing ones. This is known as position sizing. Say I make two investments. One stock goes up by 100%, the other drops 10%. Sounds like a win, right? But if I put $1 into the winning stock and $1,000 into the losing one, I'm down $99, even though one of my stocks doubled. That's why position sizing matters. One way to think about risk is in the context of surprise. The history of financial markets is the history of surprises, both good and bad. When I invest, I look for opportunities that surprises are disproportionately likely on the upside, not downside. I want to answer, is this stock more likely to surprise me in the right direction or the wrong one? I look for companies with a long history of consistent performance. Businesses that act like a machine, quietly generating value year after year. I also like beaten down companies because of low expectations. Those create upside. If no one expects much, even decent news can drive the stock higher. Contrast that with Tesla. It climbed for years on Elon Musk's promises. But when expectations are sky high, the fall can be brutal. Okay, so how do you de-risk your investments? There are two ways of thinking about this. First, you can look at individual companies that are risk-averse in behavior. Avoid companies that are all hype and no substance, that have high debt, negative returns on capital, like you invest $1, they bring back 80 cents, fads that can disappear tomorrow, or you can take the much easier approach. You can follow the ultimate investing best practices. 1. Invest in index funds. Instead of trying to beat the market, buy the whole thing. Over the long term, markets tend to rise about 8% per year. 2. Extend your time horizon. The longer you hold, the more your risk decreases. Over 10 or 20 years, the odds shift in your favor. 3. Use dollar cost averaging. Invest automatically every month. Some days you'll buy high, some low, but over the long term, you'll capture the average. And 4, don't check your portfolio. The best performing portfolios tend to belong to dead people because they're not messing around with their investments. If you want to make money in the markets over the long term, those 4 points have proven statistically to be the surest way to win in the stock market. If this video has helped, click like and subscribe, and drop a comment below about how you define risk.